Hi, my name is Clay Allen, and I'm in the Atlanta office of Old Capital Lending. You probably know Old Capital as a nationwide multifamily lender, and would love to help you out to that end. However, I'm in the middle of putting together some videos on the topic of asset management. And so to that end, wanted to provide you with some value in case you're looking to maybe get into the asset management field on a W-2 basis with a local sponsor or something like that. Or if you are an asset manager by default because you just bought your first, second, third, or fourth property. If that's the case, congratulations. And what I do, if you have not watched this first video I put together, is on the position itself. Go back and watch that. What we do in that video is just kind of walk through some of the day-to-day routines, what's being asked of you as the asset manager. And then also we kind of looked at where the asset management position sits within the realm of the organization. So kind of right there in between the property management team and I'll call them the capital markets team, the owners, investors, lenders. And then we also kind of take a look at the qualifications that hiring managers typically desire when they're hiring for that position. This one, I really wanted to focus on the two primary roles of the asset management position. So let me jump into that without further ado. Now, the first would be to maximize value when we're talking about the two primary roles. So if you're to ask any CRE professional, commercial real estate professional about just this question, what's the primary role of the asset management team? It would be to maximize the value of the underlying assets. I cannot disagree one bit. I think it's actually accurate. And really what I would say in that realm, focus on kind of the top line, and I mean the very top line, the gross potential, and really on rents, the rent growth. Now, you might be looking at that and saying, Clay, wait a second, I can't really dictate what the market does, right? I can't help it if a property comes and a developer and puts a property right next to mine. Fair enough, I get that. However, if you're a value add player, let's say, and a lot of us are, you're buying property on a value add basis, well, you have more control than you think, and you play a bigger role than you think. So in that scenario, let's just assume you buy a I don't know, 200 unit deal on a 5-year hold, and you want to renovate 50 units over a 24-month period. Okay. Well, you obviously want to get those done as fast as possible and make sure that you hit that 24-month period, because that's what's in your pro forma. That's what's driving the returns that you promised your investor. So the way you do that as an asset manager, you're not going in yourself and swinging hammers and renovating the property. Obviously, you're working with your construction management team or the property management team, whoever's running the program. You are kind of staying on top of them, kind of quarterbacking that function, that initiative, if you will. So you're making sure that they're staying on pace to get the units done on a timely basis. You are looking to see that those units don't sit too long. And if they are, then maybe they're not getting the premiums that we really want. Then you're looking to see if you are getting the premiums and you're staying within budget on the cost for the renovation for each unit. So doing all those things will help you to hit that, say, 24-month mark and push your rents above what market is giving you. And that's probably the most effective, biggest bang for your buck type of way to maximize the value of the property. I would also look for other income streams, try to enhance or set up new income streams there. One thing that comes to my mind when I'm looking back at my asset management days, I remember we had a nice newer property here in Atlanta. And before it became a thing to charge amenity fees, we thought about doing that. And I initially had a little bit of fear around that. I didn't want to turn prospects away because I just didn't want them to get feed to death, right? But we introduced it and it went off gangbusters. It went totally fine. No, in fact, I don't think there was any complaints from prospects, and our leasing didn't slow down a bit. So boom, we just created an income stream, more or less, that can be captured at the residual. When someone comes and buys the property, they'll recognize that and underwrite it. And so therefore you are bringing your purchase price up or your sales price up a decent amount. There are so many different ways. And a lot of times you kind of focus in on the other income items, you can find opportunities like that, maybe let's see, reserve parking, let's say pet fees, pet rent. There's a number of different items you can do. You can look at to see, hey, maybe if we can kind of sneak this in, can we make this part of the income stream going forward? So another way, I guess, you could look at this also is to operate the property more aggressively on collections. If, let's say, this seller, the person you bought the property from, was not really chasing down rent like they should, not knocking on doors, not placing phone calls and emails and being aggressive. Maybe you can come in and be a little bit more aggressive. You take write-offs down from 1% of GPI down to say 50 bips. So as long as you can do that and prove that out on the back end, you're creating value on that residual sales price. A lot of other ways, I won't go any further. I'll keep on moving here. But reduction in expenses obviously will increase your NOI. Now it's a very important thing to focus on, and you will find yourself doing that as you go through your reviews, your monthly reviews. You are comparing your expenses to what you underwrote and what you put in the budget. So you will obviously be on top of that. But I would say that the biggest bang for your buck is going to come on the top line, the income streams that you create. But again, continue to work the expenses down as much as you can without cheapening the property or hurting the property, right? While you might not get a big residual kick off of it because the next guy's going to come in and underwrite their own expenses, what you will be doing is creating more cash flow intermediately, so you can pass that on to the investor, or maybe just hold on to it and return it when it's time to sell the property. Prudent capital spend is another one, and that one really just talking about your capital budget, what you've raised to spend. Don't spend capital on what you don't need. You might close on a property and you may have thought you were going to have to do some big project, maybe a paint project, and you get towards the end of your term, and you're like, you know what, we haven't painted yet, but you might look at it and say, it doesn't make any sense. The next guy's going to come in and want to do his own color scheme anyway. So why spend the money now? Same with, say, clubhouse furniture. No reason in spending that, say, within a year of sale, unless it's just really horrible and it's hurting your leasing. But be judicious about what capital you spend. Once the dust settles after you take over, take another look at your capital plan, see if it still makes sense. And then if it doesn't, reallocate funds to more value-added type programs. Timing of sale is something you're always looking at as an asset manager after you close. You don't just buy it, set it, and forget it, right? You don't say, I'll check back in 5 years to see how the market's looking, then maybe we'll sell. You're really looking at market conditions all along. It could be the neighborhood starting to go downhill, and you want to kind of cut your losses before you really see an issue. Or the flip side, you may get to the end of 5 years and you're like, man, this market's really starting to take off. There's a lot more meat on the bone, or a lot more upside to this investment. So those are some ways to maximize value. I would say just timing of sales is very important, but focus on the top line, those income streams, enhance the income. The second primary role is something we haven't really thought about too much over the past few years, only because we've gone through such a run of strong fundamentals and cap rates that have been lowering, is to protect the equity that's already been given to you, right? Where one is kind of offensive, where maximizing value is kind of playing offense, protecting the equity is kind of defense. And you'll find yourself as an asset manager playing both sides. Now, the best way to protect the equity is to buy it right in the first place, right? Don't really get in over your skis in underwriting a deal just because you want to win the deal. I see a lot of people on LinkedIn today and wherever, they are really excited, and they should be, but really excited about taking down a deal and bragging about it and high-fiving each other. That's great. But as I record this today, it's a pretty competitive market trying to win a deal these days. So you're inevitably going to find yourself pushing on certain assumptions to make that deal underwrite and provide the returns that you want to see. Just don't push too hard. Don't do anything that's just unrealistic. Don't buy the property just to buy the property. Remember, you're making an investment, not buying a property. So underwrite it correctly, believe in the numbers, especially if you're raising capital to take the thing down. You are a fiduciary of the investor. Loan covenants is another one. When we talk about the loan, there's a number of affirmative and negative covenants that you're supposed to adhere by. Usually that's no big deal. It's kind of boilerplate language, but there's some things you really need to pay attention to. Maybe any kind of debt service coverage hurdles, maybe a debt yield hurdle, anything like that you want to stay on top of. And when I say stay on top of it, don't just simply report it within 45 days after the quarter end, like the loan documents say, or just forecast it out. Make sure you see the cash flow, how cash flow should play out in order to meet the hurdle itself. Also, and this is just kind of a tidbit, when you have a debt service coverage hurdle or a debt yield hurdle, make sure you understand the definition of what that really means, because it's not simply NOI divided by debt service in the case of a debt service coverage, right? It's actually, there's a specific definition in most cases around what NOI really is. It might include some reserves. It might be trailing 12 expenses and a trailing 3 income annualized. You never know, but go definitely research your loan agreement. Make sure you know it very well. Same with debt service. It might be the greater of a trailing 12 debt service, or maybe the prevailing rate at a 30-year AM. So you never really know. Just make sure you know that and going in, and that you test it well before the test is due. If you find yourself get into a bind and possibly failing the test, and you're looking ahead maybe 3 months, you're thinking it might be pretty difficult, you want to raise that up to people internally, or you want to maybe go ahead and send that out to the investors. Hey, listen, this is something we have on our radar. We're working to cure it. Talk preemptively with your lender, perhaps. Just kind of get ahead of it. Make sure it doesn't become a bigger issue than it should be. All right, JV agreements. I wanted to kind of touch on that. I mean, I know a lot of us are syndicators, may not have a JV agreement, but in the spirit of a JV agreement, maybe preferred equity or whatever. In the same way a lender has remedies like the debt service coverage ratio, remedies around that, your investors will have certain remedies as well. If you're acting in poor faith or bad faith, perhaps you're just grossly mismanaging the property, or you're not reporting on a timely basis. Could be that there was a capital call that's needed, and your JV partner can raise the capital $500,000, but you're having trouble getting that $500,000. Well, they might fund it and charge you default rate interest. They might exercise some of the remedies like a buy-sell agreement. We won't get into that, but there are certain remedies spelled out in the JV agreement that you just have to be abreast of course, but you don't want to put yourself in that position to begin with. So just knowing your agreements, trying to get ahead of any potential problems that spring up will benefit you in a great deal. Finally, cash flow. Cash flow is what we say is the lifeblood of the asset, right? Knowing what your cash flow is would mean really getting to a rhythm of reforecasting the property, the operations, looking ahead 3, 6, 9 months. And that way we can go back and say, okay, well, at this performance level, we are going to meet or exceed our debt service coverage hurdles. We are going to produce enough cash flow to pay the investors the 8% cash on cash we promised them. So that just kind of keeps you grounded, keeps you into the business of the property. So keep that in mind. You always want to kind of do a reforecast, at least on, I'd say, a quarterly basis. If it's a problem asset, you want to be doing that monthly, just to make sure that nothing really pops up to surprise you. Operating cash and reserve balances, that's one thing you're going to be paying attention to. And you obviously just want to make sure you have plenty of operating cash to pay the bills, to pay the debt service, to pay your investors. We just talked about that. And then the reserve balances could be capital reserves. It could be replacement reserves. There's a number of different reserves I've seen over my years as an asset manager. You don't have to be, you don't have to log every single expense and keep track necessarily of everything that kind of inflow and outflow of those reserve balances, but just be mindful of how much you have. So there's a little bit of a balance sheet, a little bit of operating statement you're kind of watching as you review these financials. All right, so that's the two primary roles as I see it. Again, my name is Clay Allen. Here's my contact information. If you have any questions, please don't hesitate to reach out to me if it's on this topic, or just if you want a loan quote for any deal that you're looking at. I'm more than happy to provide that for you. And I appreciate it. I'll see you on the next video.